Buonasera a tutti. Buonasera a tutti, sono Matteo Riccardi, responsabile della programmazione degli eventi formativi di CFA Society Italy. L'evento sarà in inglese, per cui perdonatemi, passo direttamente all'inglese. Welcome again, everybody. I am very pleased to introduce this event because it used to be an event which we have planned before the crisis. And so at the beginning, we thought that this event would have been cancelled, but then we have been able to organize it as a webinar. And so let me say that I am very pleased about that for this effort. And I would like, first of all, to thank our partners, Banor and SASB. As you know, the topic of the event is about data analysis and ESG rating. And I very briefly introduce our three speakers. So Francesco Castelli, who is the head of fixed income at Banor. Angelo Media, who is the head of equity and ESG research at Banor, and Nicola Landi, who is director and market outreach at SASB. I would recommend you to, as you may see in an email address, so I would recommend you to write us your questions. And please to help me, as I will be the moderator, and as you may imagine, I am not extremely familiar with all these webinar activity. If you please write exactly to whom the question is addressed. So I would first of all introduce the first speaker, Francesco Castelli, who, as I said before, is the head of fixed income at Banor, who will discuss a very few minutes about another project which we have at CFA Society Italy and which is very important for us. If you follow our activity, we have realized a few guides in order to provide some research on different topics. And Francesco Castelli will address as the last guide to which we have worked on. Thanks again, and I will jump later to introduce the other speakers and again for the Q&A session. Very last remark, we will try to end the event at 7:45, something like that, in order to avoid to keep it too long. Thanks again, and enjoy the event. Thanks.
Thank you very much, Matteo. It's really a great opportunity to be able to talk to you about this new publication curated by CFA Society of Italy, the guidebook to value investment. Obviously, Banor couldn't be a prouder sponsor of this guidebook. Our company was founded as a value investment house with a mission of bringing value investment to Italy. Obviously, in these 2 decades, value investment no longer needs our introduction. On the other side, we've seen a fairly extended period of underperformance of value as a style, casting some doubt on value as an investment methodology. I think the book does a great job in drawing a distinction between the two. Several CFA members have contributed. Obviously, a big thank you to Dennis Montagna, who's authored the first 3 chapters. And here you can find a complete overview of the investment approach. When I say complete overview, I really mean it, because Dennis offers a historical and philosophical perspective of this approach. But don't get me wrong, Dennis is an engineer, and so you will find an extensive number crunching supporting all his thesis and an extensive set of charts and tables. In chapter 4, Antonio Amendola focuses on owner's earnings and show that this metric is vastly superior to standard earnings. And finally, in chapter 5, Alessandro Capeccia will shed some light on underperformance of value as a style in the context of a multi-factor analysis. We at Banor, we've contributed with several editorials. Let me mention two of them. One has been written by Angelo Meda, which is going to be speaking after me, and it's very up to date because it discusses how value can be used as an analytic tool at the time of COVID-19. Another has been authored by Tommaso Mariotti, where he tries to show how you can be a value investor and still beat your benchmark. And interestingly, Tommaso actually manages an investment line named Value, and has actually managed to beat his style neutral benchmark for quite a few years. So really, I think take a look at this guide. You will not be disappointed. It is really a good quality. And now let me hand over to Angelo Meda, who's going to discuss the importance of data analysis for ESG investors and for the production of ESG ratings. Angelo, back to you.
Thank you very much, Francesco, for the introduction. So today the topic is about data analysis and ESG rating. I would like only to make a couple of remarks before talking about the data issues. We are asking ourselves if ESG is a strategy or if it's something that today you need to do in any case. So in slide 2, these days there is a lot of discussion also about the flows into ESG products, if ESG is able to beat the benchmark and the indexes also in times of COVID-19, etc., etc. So ESG into passive funds, blah, blah, blah. So looking at the first sight on these topics, ESG looks like a new investment strategy. But actually, our belief is that no, it's not a new investment strategy. It's not something that an asset manager can claim. So I am investing with ESG. No, you must invest using also ESG data into your process. And if we go to slide 3, also here we try to ask ourselves which is the right ESG strategy. So we can talk about why we believe that ESG is not only a style of investment. You will find that in every asset manager does have a style. So we are value investor, there are growth investor, there are GARP investor, there are investor which uses factors, there are quant investor. You have a lot of different investors, but even in ESG you will have different styles. So styles can be exclusion, can be using external rating, can be introduction and implementation into the evaluation of ESG ratings, raw ESG data, can be used into risk management. So we believe that every asset manager will choose the most appropriate ESG implementation and strategy based on the experience and especially on the skills that every analyst and every portfolio manager and every need of the company will have. So the concept is that there is no magic recipe to ESG. We are not here to say that ESG is the best, ESG, I don't know, exclusion, best in class or whatever is the best strategy. We will see a lot of different ESG strategies, and we are not here to say which one is the best. Of course, we believe that we are using the best approach, the most right approach, but time will tell. But there is always a but. So here today we are talking about data. So on slide 4, we talk about the issue of data. I don't know your job, but my job and the job of a financial analyst in these days is overwhelmed by data. So we spend the day in front of screens looking at numbers. We have several platforms, Bloomberg, Refinitiv, Reuters, DataStream. I can tell you 1,000. We look to financial data, we look to different kind of data. So we are totally overwhelmed by numbers and by raw data. So we all hope to have a screen, to have a clean desk to be able to manage all these different kind of data. But when we have too much data, the risk is to have a lot of noise and not be able to extract the most important information. So in slide 5, there is if somebody of you have ever studied computer science, one of the most easiest and common rules is garbage in, garbage out. So you can have the best model, going back to what we were saying before, you can have the best ESG screening data, you can look to everything perfectly, you can have dozens of PhDs working on the model, but if you don't put the right data, you will get garbage squared results usually. So data is, in my opinion, much more important than the model itself. So going to slide 6, I want to give you some examples and issues which we have met during the years. This presentation is it's more a talk from myself to yourself because we are still in the early days of ESG. So we will have a big future on this topic, and there is a lot of adjustment which are needed in the future. So more than giving you the results and some final remarks or whatever, we want to talk about, we want to give you the message that we are all working on this. It's an ongoing business, so please work you too on this kind of stuff, because the industry in general needs a lot of new information, new ideas, etc., etc. So some examples of what we are seeing, we have seen, and we will probably see. So staying on the topic of COVID-19, which is the most up-to-date topic on the mouth of everybody. What I am expecting next year is a lot of distorted data. So a lot of companies, for example, will claim that they have reduced CO2 emission. Okay, fine. But if you have closed for 2 months your plants because there was the coronavirus, who cares? So it will be very interesting to see what will the company say to the market in absolute terms, because we have to understand that this is a recession year all across the world, and the data will be distorted by what we have seen on the pandemic diffusion. The other topic or the other issue is the not comparability of some data. So as of today, I have to say that if we take the most important stock, so companies, so the top 200 of the S&P 500, the top 200 of the Eurostoxx 600, I have to say that the data is quite comparable sector by sector. But if we go beyond that, especially on the mid and small cap arena, we find a lot of data which are not comparable each other and are not consistent. I was talking with a company some weeks ago, and they weren't able to talk about scope 1, scope 2, and scope 3 CO2 emission. So just to give you the idea that when we go into companies which are not so careful about ESG issues, there is a lot of confusion even for them. Then another of the biggest issue we find is the topic of the limited updates. So most of the data we gather for the ESG analysis is based on sustainability reports, which are issued every year, usually. If you think about it, we are looking now in the month of May on data which we're referring to last year, 2019. since then, the world has changed. So these first 5 months of 2020 have seen a lot of changes, and the pandemic, the technology, a lot of changes in our habits. So 5 months is a very long period as of today. While maybe 10, 20, or 30 years ago, 6 months was not so important in terms of time frame, now everything happens more frequently, more quickly, and we need more data. Before I was saying that we are overwhelmed by data, there is too much data. In reality, we have a lot of data, but most of it is useless. We need more frequent but relevant data, material data. And finally, we have seen also cases of random data. So the data that the company are reporting on ESG topics are not the results of the work of the management or some policies or whatever. It's just that they happened like that, and the company took them as a result. So that's why we believe that data is important, but it's important also to understand how we get to the data. We want to make an example comparing what we do as a value investor in terms of financial analysis and what we do in terms of ESG analysis. So our job as a value investor, as you can see in the guide, is to identify the competitive edges of the company. So and to buy them when there is a big discount on what we believe being the fair value of the company. So on slide 7, you can see that in terms of value investing, we are doing that. So financial data are the results of competitive edges, competitive advantages that the company have mixed with a good management. On ESG, we want to do the same thing. So having good data and good results must be the outcome of correct procedures, correct strategy, correct ideas of the company, mixed with a conscious management. Here, we are not talking about good management or great management or whatever. We use the word conscious because it's important, in our opinion, that on ESG data and on ESG issues, the management of the company must understand which are the proper issues to manage and the data to check instead of a generic being good or being great or whatever. Here, what you can see is that in both kind of analysis, on the financial analysis and ESG analysis, the only word which is repeated twice is management. So people is more and more important. Is important on financial analysis and important on also on ESG analysis. Probably it's even more important. I always like to say that economics is not mathematics, but it's a social science. So people is very important. So to go on with what we do in terms of ESG, in slide number 8, our approach is, of course, starting with the raw data. We use the raw data because we want to have the less manipulated and the more clear data available on the market. And we produce an internal rating. We use the SASB materiality map, which Nicolai Landi will explain later, and et cetera. But more importantly than that, our model, it's important the message we want to give. So we want to go beyond the numbers. We go beyond the numbers on financial topics. So we want to understand why the return on equity of a company is better on the other, why the sales growth is better, et cetera, as part of our value investing. On ESG, we also want to understand if the company is having good metrics for the right procedure, the right consciousness of the management and everything, instead of greenwashing or looking to the best data or the most important topic where the market is more interested in every single moment. That's why we don't want to exclude, to work on exclusion, for the lowest, let's say, internal rating score, but we wanted to talk with the company and to understand what is their strategy on ESG topics, to understand if they are aware of what we believe are the most important topics, and if not, if there are other topics, or et cetera, et cetera. So we are spending a lot of time meeting the companies. I can tell you that while until something like 3 years ago, 100% of my meetings were dedicated to financial questions. So what's your expected sales growth, competitive analysis, et cetera, Now, something like 30–40% of my question and my time spent with the companies are on broader ESG issues. My personal opinion also on what's happening this year is that the S, the social, will become more and more important this year, more probably than E and G, which were the most easy to analyze, the one with more data available. So that's what we are doing, spending a lot of time talking about that to understand what's beyond the raw number that we get on any kind of database. So concluding on slide 9, who follows Banor probably have seen these several times. So it was written by Professor Serafim and Gabriel Karageorgiou in 2017, so 3 years ago. Looks like a lot of time, but these words, in our opinion, are up to date. So ESG analysis will not replace financial analysis, like machine learning and fintech or whatever will not replace portfolio managers. However, managers who leverage ESG data along with financial data and utilizes technology advancement will replace those who don't, to define active investing 2.0. So the message here is we are an active investor. We do a lot of work deviating from the benchmark and investing with a value investing approach. We are doing the same on ESG. So we are using a lot of ESG data in our financial analysis, and like what we do with the value investing, we go beyond the numbers. We want to see the management and to understand what they are doing on ESG topics, and to understand if the final data is the outcome of a good process and a good management, or if it's only random or dictated by casual.
Yeah, thanks, Angelo, and thanks also again to Francesco. I am now very pleased to introduce our third speaker, Nicolai Landi from SASB, and good morning, Nicolai, and he will provide us the American perspective in addition to, of course, the perspective which is slightly different than the one of a portfolio manager and an analyst. Thanks, Nicolai. Thank you.
I was supposed to be in Italy right now, but we've all been affected by the virus. So let me start with slide 1, and we will just talk through more of the challenges in ESG data that Angelo did a very good job explaining. And really, it's important, I think, to keep in mind that idea of garbage in and garbage out. So on slide 2, we will see some of the topics today. We'll talk about how much data has become available, but where some of that is good, some of it is bad, and some of it's not very good at all. And then a little bit of a look at how SASB and I think that ESG data will continue to evolve. So on slide 3, we'll just spend a little bit of time introducing the growth in ESG data. for the next few slides. So starting with slide 4, we have seen over several years a large and fast growth in sustainability data being reported. This is one analysis that shows that now over 80% of the S&P 500 are reporting sustainability data, and you would probably see even higher in the Euro Stoxx 600. And we think that there are a variety of reasons for this, but there's a push and pull mechanism for the data. And so slide 5 shows us how some of the data is coming from demand and pull from a lot of data and ratings companies. And you probably are familiar with many of these, MSCI and Sustainalytics and Bloomberg and Robeco SAM survey, which is now owned by S&P. So there's been a lot of companies which are very different from SASB, but have really been evaluating companies and helping pull data into the market. And then slide 6 shows us that there are also a push to try and supply more data, and that comes from standard setters and disclosure standards like SASB and like GRI. And these are very different organizations because they don't evaluate companies, but they provide guidance for disclosure. And SASB has an industry-specific identification of sustainability data, and GRI lets companies identify the data that's most important to them. So this is really some of the reasons that we've seen growth in ESG data. But if we go to slide 7, we'll start to talk about some of the good aspects of that data, and then some of the ways in which it can also be garbage or problematic, as Angelo was saying. So slide 8, this is something, if you've worked with ESG data, you would already know, but if you have not worked with it as much, there can be wide variety of coverage from one data source or data provider than another. And so these are 3 different data providers looking at human capital. So if we think of S and social issues and human capital issues and the importance in the times of the COVID-19 pandemic, you see that one data provider provides only a little bit of information related to compensation, but a lot more information related to labor practices. But different data providers have different levels of information that they analyze. And so if you go to slide 9, what you see is that when you aggregate that up, some data is very prevalent, like scope 1 greenhouse gas emissions is the most common set of data. But as you look at other ESG issues, the data availability becomes less and less prominent. So employee health and safety is a little bit further down, and then even data privacy, there's much less information that is usually available, even when you add up multiple data providers as we have here. So if you go to slide 10, one of the results of this market is that large cap companies, as Angela was saying, the top 200 in the S&P 500 or the top 200 in the Euro Stoxx 600, they have usually provided more information and more data earlier, and they have higher scores. And so no matter what region you look at, whether it's Americas or Europe or Asia Pacific, you see that larger companies have higher scores. So you see a large cap bias in the existing ESG scores. And even though there's a lot of data, that doesn't necessarily mean there's a lot of consistency in how companies are analyzed. So you go to slide 11, and you see that, again, even with all this data, there is not a lot of correlation. And so hopefully you can see the numbers here, but it shows that Sustainalytics, MSCI, and Robeco SAM and Bloomberg, they all have very low correlation between the ratings they give the same companies. And then you go to slide 12, you see the same idea where GPIF conducted research to see a lack of correlation between FTSE's ESG rating and MSCI. And then you go to slide 13, and we see the same thing from an academic paper out of Austria, comparing the Refinitiv, Thomson Reuters, SF4 data with Sustainalytics. So even as there is lots of ESG data, there's very little correlation between the ratings, and that can lead to very different analysis based on which ratings provider somebody has. And so if we go to slide 14, all of these challenges with different ratings providers collecting different amounts of ESG data, not all ESG data has broad coverage, and then large caps have a bias, then what we see is there's usually strong dissatisfaction with the quality of ESG data today. And this is from a couple of years ago, showing that over 90% of investors were dissatisfied with the ESG information that could provide insight into how a business is managed and how to compare peer companies. And so if you go to slide 15, what we see is that that is very different than how companies think of ESG data. Companies on the bottom have a lot of confidence in ESG data, but above that, in green, the investors have much less confidence in ESG data. So there is a market problem with ESG data quality and level of confidence. And there's, we think, a couple reasons for that. One is on slide 16, that ESG data was originally not designed for investors. The early days of sustainability and ESG reporting were focused on a broad range of stakeholders, like customers and employees and communities, and not as focused on investors. And so this is an example of a report from 2015 that has comics and illustrations that are not something you would expect to see in an investor-oriented document. And so there was not a lot of focus on investors, at least in early years of reporting. And then you go to slide 17, and you see that when you look at the type of data being reported, most of it is policy-based. Does the company have a policy to protect whistleblowers? Or does the company have a policy to respect labor conventions? This is a yes or no question. And lots of companies could say yes, but they could have very different management or very different protocols, as Angela was saying, in terms of how a company needs to think about ESG. And so when most of the data is yes or no policies, then you don't get a lot of insight into company management. And only 12% or so were actual performance-based data that indicates how a company is managing and performing on the issue. And you look at the top 25 most disclosed data points, and only one of them was numeric. Everything else was kind of policy-based. And it was the 25th out of 25, and that was greenhouse gas emissions. So the growth in ESG data is not necessarily growth in data, it's actually growth in policies or statements that aren't always easy to compare performance. And you go to slide 18, when companies are trying to provide data and more numeric information on slide 18, then we see that it's still hard to compare. This is from 11 large apparel companies, things like Nike and Adidas and Puma. And in data that they disclose related to labor conditions in the supply chain, then the companies are all reporting slightly different numbers. And so they are providing numbers, which is good, but the type of information, the type of numbers is not always very exactly the same. It is difficult to do apples to apples comparison. So these are some of the challenges with ESG information historically and even sometimes today too. And so let's look at slide 19, which can give us a little bit of time to talk about where we see the future of ESG data and information. And so on slide 20, we can see this example of sustainability and ESG reporting that was not necessarily targeted towards investors. And then this company on slide 21 started using the SASB standards to provide more investor-focused reporting. And you can see the data table with a lot of numbers to compare. And then the look and the style is much more similar to what you would see in investor reports. And so SASB's goal is to promote investor-focused communication on ESG data. So slide 22 gives you a little bit more insight, and we'll talk more about SASB's work now that we've talked about some of the challenges in the ESG data space. And so we are an independent nonprofit NGO that works with companies and investors around the world to connect on the financial impacts of sustainability. And we do that industry by industry. And so we think that with more comparable and numeric disclosure, we can see a better use and easier data analysis for investors of all types. And so slide 23 shows our vision for the future, which is we want every investor to be able to pull up any company, not just the large caps, but the mid and small cap companies, and be able to compare a handful of important ESG metrics and be able to see how one company is performing relative to another. And that is how we are working with companies and investors to try and achieve this vision. And on slide 24, we are starting to see that change. This is a company, a real estate company, that started reporting a couple years worth of data. This was a little while ago, a couple years ago, but they're showing multiple years of data on energy and water use. And they say that it helps them manage their business and track progress on resource efficiency and renewable energy sourcing. And so this is data that is useful for them as management, and then also is important for investors to evaluate management. So we are starting, it is early, but we are starting to see these this vision of comparable data become more possible. And so on slide 25, one thing that is really important is that there has been a lot of focus over many years to have more and more data, and that more is better. But as Angela was saying, sometimes more creates noise. And so SASB is focused on a bare minimum of data points and metrics that are most important to a company. And there can be additional data points. We are not providing all of the information that can be disclosed, but we are trying to focus on the minimal set that is useful for financial analysis. And by doing that, we can help not only the large companies, but also the smaller companies who don't have as much time or resources to report. And they can report a consistent data set when there is a limited focus. And so these are, SASB analyzes 77 industries. This is one of those 77. This is the automobile industry. And you can see this is the data that we ask companies to report. And this is it. There's not more information. And so that focus can help them not only be sure to report the data, but it also allows them to focus on performance and management, because you can't, as a company and as management, you can't do everything and you can't improve everything. And on slide 26, you see that this focus is very different than some of the data providers like MSCI and Sustainalytics and Bloomberg and others that have often tried to collect more and more data. This is an example of the number of data points that SASB encourages companies to disclose in red on the right, versus a data provider in the looking at an electric utility company providing electric power, and how they have over 100 more data points that they are potentially analyzing or asking for disclosure. So that focus can reduce the noise. And so slide 27 gives you some insight into the types of ESG data that SASB's work analyzes. We look at environmental issues and social and human capital issues, but also the management of these issues, like supply chain management and product design and critical incident risk management, analyzing risks from critical or bad events. And so on slide 28, SASB, as a nonprofit, is focused on doing this research in a very transparent way. And so the next slide shows us our process for getting market feedback, where we start with industry research. We then have thousands of points of feedback from organizations around the world. And then we vet the feedback that we get, and we publish draft versions of our research for public comment, and then that gets revised. So this is really important, because this is the same way financial accounting standards work, is that they do research, they get feedback from companies and investors, they publish draft versions for feedback online and in the market, and then they have decision-making standards board to make the updates. And so we go from the 26 sustainability topics that we talked about on the last slide, and we end up with an average of 6 and 13 metrics per industry. And so on slide 29, you can see all of the different points of feedback we have received since 2012, where we had working groups for every industry. We've had hundreds of public comment letters. We've had hundreds of consultations with analysts and companies and industry associations. And so this has really helped make the standards reflect a market view and market insight, because the companies and analysts covering those companies have a really good sense of what is important, rather than just the staff at SASB. And so there have been thousands of people around the world who have participated in giving feedback. And so slide 30 shows us that our analysis, to be useful for investors, starts with understanding financial impacts on revenue or cost or assets and liabilities or cost of capital. And different ESG topics have different financial impacts. If you're looking at a food company, the health and nutritional aspects of that food can impact demand for the products and revenue. Whereas if you're looking at an oil and gas or coal company, the risk of stranded assets is going to affect asset value differently than how health affects foods and demand. So each topic can have different financial impacts. And if you look at slide 31, by using the process that we have to get market consensus and focusing on financial impacts and keeping a narrow focus on a limited set of topics, what research from Seraphim and others from Harvard Business School, as well as from Russell Investments, have shown that using the SASB focus on ESG data, as opposed to the generic scores you might get from MSCI or Sustainalytics, the SASB-focused, narrower set of information helps reduce the noise and can provide better opportunities for alpha. And so on slide 32, we'll talk through a little bit of how this work is being used around the world, where over 50% of the people downloading standards are outside the US, 410,000 downloads over the last several years. We have Italian companies reporting with the standards. Some of them are listed here on the right side of the page. And if you look at slide 33, you can see that we get feedback from and have participation from organizations around the world, not only in the companies reporting their standards, but our investor advisory group, the organizations that license SASB standards to be able to use in the investment process, and the feedback that we get from our standards advisory group. So there's broad global feedback in SASB's work. And then slide 34, you can see just some of the European asset owners and asset managers that we work with all over the United Kingdom and mainland Europe, if you look at slide 34. And so this includes the Netherlands, Norway, Denmark, France, Germany, et cetera, et cetera. So lots of uptake on that slide. So if we quickly show slide 34. Yep, so this is some of those firms. And then slide 35 provides a little bit more insight into how we see SASB in use with the EU non-financial disclosure. So slide 35 shows us the guidance from the European Commission on financial materiality on the left side and environmental and social materiality on the right side. And slide 36 shows you where SASB and GRI fit together and work together to SASB provide focus on financial materiality and GRI provide focus on environmental and social materiality and the impacts companies can have. So slide 37 provides a little bit more insight into the broad how SASB, now that you know more about our work, how we fit into broader sustainability and ESG initiatives, where you have frameworks, which are very different than standards. Frameworks provide a process for how to collect and report information. And this is like the TCFD and CDSB and IRC for integrated reporting. And then standards are not the how, but they are the what, the metrics, and the data that companies should report. And that's where SASB and GRI fit together. And you can see example of a framework providing a guidance on how a company should discuss strategic planning, but how a standard would say that a company should disclose carbon emissions embedded in hydrocarbon reserves. So on slide 38, you can see that with SASB's industry-specific approach, when it comes to climate risks, we think that companies should report different data based on their industry. Whereas an agriculture company might report emissions, a real estate company might report the number of properties they have in flood zones and coastal areas that might be impacted by changing climate. So different industries have different metrics in SASB's work. And so the last few points here on slide 39 gives you an example of how something like SASB and GRI work together to provide different insight to different stakeholders. So on this shows you that you could have different stakeholders like investors and employees and communities, and they can sometimes rely on different information for different decisions. So on slide 40, if you're an investor thinking about should you invest in a pipeline company, this shows you some of the data related to critical incidents and workforce accidents, and how there's some data in the SASB standards at the top that can provide insight into companies' management and potential risk with these critical incidents. But if you go to slide 41 and you are an employee, you might be asking yourself a different question, should you work for the pipeline company? And you might be interested in some of the organization-wide risks, but you're probably more interested in some of the GRI indicators around training and around how they work with the employees, promoting safety. And then on slide 42, if you live in a community where this company operates, will your life be impacted by this company? And you might be less aware or find it less important to find workforce training, and you might want to see more information about some of the company's system-wide incident risks, like the SASB standards, as well as the GRI standards around how the company works with local communities. And then if you are civil society on slide 43, and governments and regulators and news organizations and everyone else in civil society, you might be interested in all of the different information. So different people and different stakeholders can find use for different data points and combine SASB and GRI to help answer the questions that are important for them. So that hopefully gives you a little bit insight to where we work together and where companies can combine SASB and GRI to provide financial materiality and environmental and social materiality. So slide 44 shows us a little bit of where we think the future of this data will go. We think that there has been historically a focus on more data is better, and there will become more of a focus on a smaller set of data that's more important and removes some of the noise. And this will also allow small and mid-cap companies to disclose more consistently. And as you get more data from more companies, that's going to make better research and better analysis and provide more options for products and funds and strategies. And so slide 45 is the final piece here, where SASB sees our work being used across asset classes, very commonly in public equities, but also corporate debt and fixed income, also private equity. There's been a lot of growth in ESG and SASB in private equity in the last year, and then also real assets and infrastructure. So hopefully that gives you a better insight into SASB's work and where we fit into the ESG data and ratings landscape. So I will turn it back over to Matteo, and we can see if there are other questions.
Thanks again, Nikolai. Thank you for your presentation, which has been extremely interesting. We are collecting many questions. I do invite you to continue writing us an email at the email address info@CFA Society Italy.it, which is, I repeat in Italian to be clear, info@CFASAI.it, or you can type in our chat in order to give us the chance to collect the questions. I have grouped together a few questions which we have received till now. So I think the first one could be for Angelo. From your point of view as an analyst and a portfolio manager, how and where exactly you can find, access, download, etc. information in relation to ESG data.
Data, so the basic, sorry?
Go ahead.
No. So what I call the first level data, so the basic data of the companies, usually are obtained by the sustainability report or the integrated report or whatever, and are available on any financial database. So from Bloomberg to DataStream, Refinitiv, or whatever. These, as I was saying before, it's raw data, and it's usually old. Usually refers to data. So now in May, between May and June, we will get the 2019 report. So the second, what I call the second level data, can be found everywhere. Can be found into the internet. Google is a great source in forum, in everywhere, literally. One of the sources I have found most relevant was employees forum, or former employees, or company contacts with, let's say, middle management. What I found in a couple of times, for example, during a company visit into a plant, I was seeing things that were different compared to what the top management was saying. So for safety measures, injuries, etc., etc. So to summarize, the first level data is available on any financial database, and probably we will, in a couple of years, have some also free database, and it's quite easy. The importance of this data is becoming lower and lower year by year. We need more data points. There are several software and fintech companies which are using artificial intelligence to serve the web and find these spot of data in forum, in the social network, several news resources or whatever. We are trying them. It's still an experimental phase, so time will tell, but I believe that here is a clear example of how the technology advancement can help portfolio management. So we will, any analyst will not be able to check on the internet everything about the topic. A machine is for sure much more powerful and efficient on that. The analyst or the people must help the machine to find the correct ideas and the point of start, at least. So the real job now is to find these secondary data, if we can call them like that, which is more powerful and more difficult to find.
Thanks, Angelo. And the second question, I think, can be for both. So maybe we can start from Nikolai, please. And which metrics does influence mostly the overall sustainability of a firm? Nikolai, you have just said that more is not better. And so maybe you can elaborate a little bit about that. And so you can start, please.
Sure. So the metrics that would most influence a firm will depend, in our view, on that firm's industry. So if you are a pharmaceutical company, the safety of your clinical trials and the retention of your key research staff that develop drug pipelines can be very important to managing risk and creating long-term value. But if you are a restaurant, it's very different. It's things around the profile of the products you serve as people are exploring alternative meats, or as they're exploring healthier foods, drinking less soda. How are those reflected in the products you serve at your restaurant? How do you treat your labor force and pay them? And what are the conditions in among your labor? And then if you are a insurance company, it's different as well, thinking about exposure to the environmental and social impact in the products you insure. So if you can go to our website and download all of the standards and see the feedback we have received around what are the issues most important to a company based on its industry. And we don't find that there's any one thing that matters to every company, except probably good governance, good management, good board oversight.
Angelo, maybe before you elaborate about that, I can add to you a second question, which is partially related to this one. So you said in your presentation that the S, so the social criteria, are up to you the most important. And so do you think that the social criteria are important, especially now, have become important now, considering the situation in which we are living? Or do you think that this is a general trend, and so it is a little bit independent from the current crisis?
Yes, so I totally agree with Nikolai. So to make a comparison with financial analysis, for example, I cannot say that there is a single multiple or a single ratio, whatever, which works everywhere. So PE or return on equity or whatever probably are the most important in terms of financial analysis, but cannot be used for a generic comparison of the company. So there is always something more behind the data, and on ESG it's the same thing. So I mean, I can tell you that, for example, last year all the attention was on environmental issues, climate change. We all remember the Greta Thunberg travel to New York. There was a lot of noise on the media, blah, blah, blah. So we need to separate what is the focus of the market from what is really material. So on the materiality, I totally agree with Nikolai. You have to drill down every single industry, every single sub-industry often, and check which are the main data points or procedure or issues, etc., etc. Not always you have to look to the data. Maybe a topic or an issue can also be important, and maybe you will not be able to translate it into a number. Here, for example, GRI and SASB, of course, are a great help from our side. So we can use their work to find directly the most important data points. On the topic of social, I mean, before I was saying that last year the topic was climate change and environmental. I think that this year the topic will be the social approach of the company to the virus, the coronavirus. I mean, why is it important? It's not only a matter of marketing, but for example, a company which is doing the right things in terms of securing the safety of the employees, giving them a safety net, etc., will retain the talent, while a company which is using full of system, the cassa integrazione here in Italy or whatever, can have a problem in retaining the people, the best people in the firm. So I think that social has been less of the interest in the past years in general, or was used only. I also cover the energy sector, and for energy, social was the number of injuries and local communities. So giving money to local communities where the project were made by the company. So I think we need to go beyond that. So this year we had a pandemic issue, and people will be more affected from everything which is going to happen. So I think that there will be a lot of focus on the topic. Companies, of course, will try to sell the best they have done. Our job as an analyst will be to discuss with them about it and to separate the noise and the media announcement, etc., from the reality.
Thanks. We are receiving a lot of questions, so I'm trying to group them together. And particularly for Nikolai, I have two questions which are quite similar. Do you, as you are an American entity, do you think that your criteria could be applied around the world in every countries? I'm thinking about the different kind of regulations. I'm thinking about also some political issues. Of course, I'm thinking about China. Ourselves, we as CFA Society, we are part of an American network. So we are quite familiar with this kind of issues, despite we live in Europe. And second question, let's say more concrete, do you know exactly some concrete examples of how SASB criteria have been applied in different countries, or have been a little bit adapted, changed in different countries? Thanks.
Sure, those are good questions. So even though our headquarters are in the U.S., we work with and get feedback from people around the world, specifically to make the standards relevant by industry and not by country. And so it's just like, GRI is based in Amsterdam, but is used around the world, and integrated reporting is based in London and used around the world. So the place where the headquarters is does not determine that it can't be used around the world. We spent the last 2.5 years doing a lot of work to make sure, and research to make sure, that the metrics were designed to be as globally applicable and relevant as possible. And so we have made changes for many metrics years ago in late 2018, so that they were usable around the world. We have completed that for about 80% of the metrics. Where we see some challenges are sometimes the healthcare industries, and then a small number of topics like financial inclusion in the banking industry. So there are isolated instances where there continue to be improvements we want to make. But we have, when we see, so we've done a lot of work, and we're continuing to do work to make sure there's as globally relevant and useful metrics as possible. And how we see companies using the standards is they often use, for the vast majority of our metrics, they can use the standard the same way, no matter what country they are reporting from. Usually, they will provide a SASB data table, either in a sustainability report with GRI or on the investor relations website as a separate document or something like that. And then there are sometimes when there is a metric that does not work well for a particular country or jurisdiction, they might provide a different data point and explain the difference, or they might not provide any disclosure saying that it's not relevant to that company and providing an explanation. So those are some of the practices we see, but we see a lot of uptake around the world.
Thanks. Another question which can be for both, a little bit provocative. And can we trust ESG rating agencies? Do these ratings from different ESG rating agencies differ a lot among them? And do you think that these ratings are somehow aligned with SASB recommendation? I must say that 7-8 months ago in October, I think last year, we hosted an event with Moody's and together with Banor again, and we discussed about the rating analysis provided by them. But having said that, this question, of course, is more generic. You can start maybe Nikolai and then Angelo, if you would like to add something, we'll be very grateful. Thanks.
Okay. So the rating agencies play a really important role because this data is often disclosed lots of different places and it's not presented in the same way, one company after another. So the rating agencies spend a lot of time and effort to make that accessible to you as an investor. So they're very important. And often there's more interest in the underlying data than the actual rating. Now the rating, I don't trust. Can we trust them? That's a tricky word. Can you trust the companies are disclosing right information in the first place? If the companies are not providing highly accurate information, you may not be able to trust the rating, but that's not the ratings provider's fault. So I think a different question is, do you think that the rating is as high quality and carefully monitored as something like credit rating? And that probably isn't, but I don't know if that's entirely the problem of the ESG ratings. It's also a problem with the data being reported for use. So I think that everyone right now should take some skepticism and careful review of ratings, but those ratings providers also aggregate data, and that's very important. So that's, I think, an important message to walk away from. And there are only a few of those ratings providers that are mapping and working with SASB to incorporate SASB into the service that they provide. But we think that there are more in the future. And we have agreements with MSCI and Sustainalytics and a couple others that will be done soon to provide a data map between, even if MSCI or Sustainalytics or Bloomberg don't collect SASB-specific metrics, which metrics do they collect that are similar to the SASB standards? And that's something we make available to the investors that we work with. So there is progress in terms of SASB use with those ratings providers, but the entire ESG data field has some challenges, which also makes it hard for ratings providers. So I would not think that they are, it's just still an immature industry, and we have more that we can all improve.
Yes, I mean, if the question is, do you trust rating external rating agencies on ESG? Yes, I trust them. If the question is, do you use this data is different, the answer. So I believe that every kind of rating agency or external provider or whatever do have their methodology, and they apply it in a correct way and using the most reliable data. So I believe that the industry is, the rating agency at least, they are trying to elaborate this rating. Then the point is, of course, everything is immature. If we will have a standard, probably the rating itself will lose significance. And finally, a provocation to, does anybody invest in a corporate bond based on the credit rating? So I think it's more important to understand why a rating agency gave a certain rating on that, and maybe sometimes to find if they are wrong, if they are not using the correct, the most material data, or are using old data, or are not updating it more frequently, or if there is any change in management which is more conscious and careful about ESG. So we are in the early days of external rating, so we will see a lot of evolution in the future. So I trust the rating, but personally, I'm not ready to use them regularly in the portfolio management process.
Thanks to you both. Maybe we have a few minutes for a very last question. And sorry for those questions which has arrived and which we cannot, we do not have time to ask to our speakers. Maybe the last one, Angelo, could be for yourself. Considering also the very challenging time which we are facing also in our jobs on the markets, could you provide a concrete example in relation to an issue which you have afforded to manage data in these last weeks, months, just to give us a flavor?
Well, there are several. Maybe we can talk about a couple of these. So to make an example, an Italian bank was commenting into a conference call dedicated to ESG, all what they have done in 2019 and the results, the evolution of the topics most important for them, blah, 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 etc., etc. After 45 minutes, we were talking, still talking about the policy on giving money to mortgages, home mortgages, residential mortgages with a energetic class above A+, or talking about the money gave to the customer which were using it for reducing or making investment in CO2 reduction, or their effort about the energy consumption in the branches, etc., etc. In the other 5 minutes, we have talked about the governance and risk management, and this company was firing more than 700 employees that year. So, as usual, also in the financial data and in the financial discussion, the topic is the same. So, the companies are doing a marketing job. So, even if the numbers are not good, they are presenting the nice part to the financial community, and the analyst must go beyond the presentation where all the companies are gaining market share, all the companies are number 1 or number 2, they have the best products, etc., etc., etc. On ESG is the same thing. So everybody will claim about being be the best in efficiency, in social policies, etc., etc. So our job on ESG is to challenge the companies, and what I find very, very interesting is to talk to the middle management, or even better, to non-listed companies, to understand what a non-listed company is doing. A non-listed company can tell you the real truth without any filter or whatever. So concrete example are these. So challenge the companies, and sometimes also them, also the company, when they are communicating ESG data, must be put on reality. So to let them know that they must give us the most important data and what we want to have from them, even if it's not the best. I prefer a company which says, I had an example of this 1 month ago. So one company was saying ESG was not on top of our agenda. Now it is. I prefer very much having a company saying the truth and saying, okay, we are going to improve, we want to make better or whatever, instead that a company which continues to say, oh yeah, we are the best, we have the best ratios, etc., etc. So that is an example.
Thanks a lot again. Thank you all. Thank you, Angelo. Thanks, Francesco. Thank you, Nikolai. And I would like to thanks again our partners, Banor and SASB. Banor has hosted us on their platform, so special thanks to them as well. And we will share the recording version of this event. You will receive in the next days the link in order to be able to attend the recording version, and we will also share the presentations discussed, of course, after request to our speakers if they completely agree to share them. So thank you again, and enjoy your evening and the rest of the day.